Welcome back to our intermediate financial accounting class. We have been talking about property, plant, and equipment, PP&E, through the last several sessions. We've talked about what costs get capitalized, debited into our asset accounts, and what costs get expensed, and how we can tell the difference between the two. We've done examples of capitalizing interest, recording basket purchases, and conceptually, we've talked about that rule of thumb, that we can capitalize everything we spend to get that asset ready to use. We've also done some examples on how we can dispose of assets when they've reached the end of their useful life, or when we just don't think it's worth keeping track of them anymore. We did 3 different examples at the end of our last section of these disposals. We did a sale, we did an abandonment, and then we did a loss on exchange. Now it's time to take a look at the flip side. What happens if we exchange this old asset for a new asset and it's a gain situation? And we're going to pick up with that right now. These are all of our calculations from that original exchange, and you can see up here we have our historical cost and our accumulated depreciation. I want to make sure we remember these numbers. We also have the $2.5 million that we are paying for this brand new asset, less the trade-in value, so 1.8 in actual cash. With that quick reminder of what the numbers were, let's take a look at what it will look like if we tweak things just a bit. So let's go through the exact same problem, except we're going to assume that instead of selling it for $350,000, what if you could sell it for $450,000? So in our exchange, our first step is always to decide if there's a gain or a loss, and we do that, remember, by looking at the fair value, which in this case is the $425, with its book value or carrying value, and that's the historical cost or the capitalized amount minus the accumulated depreciation, and we calculated that as $400,000. So if we subtract that, we end up this time with a $25,000 gain. That's, again, only thing we're changing from those earlier numbers is we're assuming that instead of selling it for $350, we can sell it for $425. If there's a gain, then it changes things a little bit. We have to decide, does this have commercial substance, or are we getting cash as part of this exchange? Well, you look at the numbers and you look at the values and you look at all the assumptions, and we're not getting cash, so that one's gone. So the question is, does this have substance or not? Commercial substance. And commercial substance, again, means it changes my business in a substantive way. So I can produce a lot more units, I can produce higher quality units, I guess I can produce a whole lot fewer units too. That would be commercially, that would have commercial substance. It'd be stupid, but you could do that. But hopefully you're getting better, not worse. But still, substance just means it's changed your business, so you could make a stupid move and still have commercial substance. In this case, we don't have details. We don't know how many more units we can produce or the quality or quantity. We don't know anything about that, but we've been told, assume it has substance. So if we assume it's got substance, then I get to show this gain right now. If it doesn't have substance, I can't show the gain. So let's go ahead and go through the rest of the steps looking for this gain that we get to show. So again, our step number 2 is to get the book value of the new machine. And to do that, we're going to get the cash paid for the new machine. And we calculated that last time. Remember, it's the $2.5 million sticker price of the new machine less the trade-in value. So 1.8 million. And then we're going to add to that the fair value of the old machine. This is the same exact equation we used when we had a loss. The only difference is now we've got a gain, and the market value is a little bit different. But same idea. Instead of using the 350, we're going to use the 425. And our historical cost for this new machine, if I add that up, is $2,225,000. And now that I've got that, I can do step 3. The best part of the process, because it's my journal entry. So let's see. The new machine, we'll debit that for $2,225,000. I'll get rid of that old accumulated depreciation, $600,000. I'll get rid of the old machine, $1 million. and I've got that cash going out, 1.8 million. And again, I look to see, okay, how do I make this balance? And if we add up our debits, subtract the credits, sure enough, you need a credit for $25,000. So you have a gain on exchange. Record exchange with substance and a gain. And there's my journal entry. The last example that we need to look at then is what if there's a gain and no substance? In that situation, remember, we don't get to show our gain. It just kind of disappears. So let's take a look at an example so you can see how we get to that no gain scenario. So same exact scenario as before. We've replaced the $350 sales price with a $425 sales price, but now we're assuming that instead of having substance, it has not got substance. So it doesn't meet that crucial test. Step one again, gain or loss. We've done this before, but we'll do it one more time. We're going to take the fair value, which is the $425, minus the cost, which is the $400,000. So sure enough, we show a gain of 25, just like we did before, but now there's no substance. So what do our steps look like? Step 2 is still to get the historical cost or the capitalized value of the new machine. But this time, I take the cash for the new machine, 1.8 million, plus the historical cost of the old machine. And right here, this is how it changes. Instead of using the market value or fair value of the old machine, I have to use the historical cost of the old machine. So I end up then with a new historical cost for this new machine of $220,000. So now, still the most exciting part, I get to do my journal entry, but now no gain or loss will show. So let's see. The new machine has a historical cost now of 2.2 million. I get rid of my accumulated depreciation. I get rid of the old machine. I record the cash. Now normally at this point we would add up our debits and our credits and find the gain or loss so we could show it right now. But if you look at that, the debits and the credits are already equal. There is no gain or loss to show. The reason for that is instead of using the market value of what I'm giving up for the new machine, the market value of the asset and the market value of the cash, I'm using the book values of what I'm giving up. The cash book value is the same as market value, but I show the value of the cash, and I show the book value of the old asset. Well, since I'm transferring book value of old to new, they match, and there's no gain or loss shown. So if you have an exchange that technically is a gain, but there's no commercial substance, what we're saying is the business hasn't changed, so we'll just use the accounting numbers. And if we just use the accounting numbers, then there's no gain or loss. It just works out. This is to record an exchange without substance. Now we've talked about a lot of stuff. We talked all about property, plant, and equipment and what we record as it comes in and we get it ready for use. And essentially the rule is all that we spend on that process gets capitalized, becomes part of the historical cost or the original cost of this asset. And then anything that we spend later that improves the value of the asset or extends its life, that also becomes capitalized and becomes part of that historical cost. We also talked about when interest can be capitalized and when things can't be capitalized and when they just need to be expensed immediately. We ended up our discussion with what we do when we dispose of assets. How do we get them off our books? And the key concept here, and it is a key concept, is the fact that Everything associated with the old asset has to come off our books. The accumulated depreciation and the historical cost. You can't leave one. You've got to get them both off of there. The last thing that we talked about then were exchanges and how we can record gains and losses if we swap things out. And it was an involved process trying to decide exactly how much can we record and do we record any, but it was fun because it ended with a journal entry. The last thing we need to talk about are the ratios that we can use to analyze our assets. And one of them we've already talked about, and that is our ROA, the return on assets. Net income divided by average total assets is a great measure of how well a company is using its PP&E. Now, same thing with asset turnover. Asset turnover includes all assets as well. Let me go ahead and put it up here. It includes all of our assets, but since PP&E is such a huge chunk of our assets, this measure as well as ROA really do give us a good feel for how the company is doing with its assets, because this tends to be the biggest piece. Now, you will see these tweaked somehow by analysts that want to see specifically what's going on with PP&E, and then they'll just replace average total assets with average total PP&E. And that works too. We're not going to get that specific, but analysts can tweak and change these ratios to whatever they want them to be for the analysis that they're doing. Now, the rule of thumb here, again, we just want it to be bigger. Bigger is better. The higher our number, the more effectively we're using our assets. Unfortunately, for most companies, it becomes a trade-off. If I've got a really good profit margin, I probably have a bad return on assets. If I've got a really bad profit margin, if I'm still in business, then chances are I've got a good asset turnover and I'm churning through things really quickly and using those assets really effectively. So I don't generate a lot of profit per sale, but I generate a lot of sales, is what we're showing. Now with that wraps up our conversation all about our property, plant, and equipment. Lots of key stuff here, lots of important issues that we need to be comfortable with, especially as we move into our next topic, which is depreciating these assets. So more fun to come. I'll see you then.